Hey, I've been thinking about starting to invest some of my savings, like for my part-time job. But everyone says it's risky, and I hear stories about people losing everything right away. What mistakes should I avoid when I'm just getting still?
That's a smart question to ask before you dive in. Investments can feel exciting, like a game where you might hit it big quick. But yeah, a lot of new folks do lose money fast. The big reason? They jump in without really understanding what they're doing. It's like trying to drive a car without knowing the rules of the road. You might crash before you even get going.
Yeah, that makes sense. But why does it happen so often? Like, aren't there apps and stuff that make it super easy now?
Those apps do make it simple to buy shares or whatever, but easy access doesn't mean easy wins. One huge mistake is emotional buying. You see a stock shooting up because it's in the news, and you think, I gotta get in on this, without checking if it's solid. Remember that time last year when everyone was buzzing about those meme stocks? People poured money in just because their friends were hyped, not because they knew the company.
Oh, right, like GameStop or something. I saw videos of people celebrating online, but then it crashed.
Exactly. No research means you're gambling on feelings, not facts. You buy high on the excitement, then panic when it drops a little. Panic selling is the killer, dumping everything at a loss because you're scared. It's like if you baked cookies and they didn't turn out perfect. So you throw the whole batch away instead of fixing the recipe next time. New investors lose fast because they let emotions drive, not logic.
I guess I felt that pull before, seeing ads for get-rich-quick stuff. So how do you even avoid getting all emotional about it?
Good point. You're already thinking ahead. Start by setting a plan. Decide what you want your money to do, like grow for college or a car, and stick to it. Research means looking at basics. What's the company? How's it doing? Not just headlines. And don't invest money you can't afford to lose. It's like saving for a bike. You wouldn't bet your lunch money on a race to get it faster.
Okay, that sounds doable. But what if I do a little research and it still goes wrong? Is that just bad luck?
Not always luck. Often it's skipping the full picture. Take my cousin. He was 19, fresh out of high school, and put his first paycheck into crypto because it was the future. No deep dive, just vibes. When the market dipped, he sold in a panic and lost half. He learned the hard way that without research, you're blind. Stats show most day traders, those flipping stocks quick, lose money over time. Only about 10% make consistent profits, and that's pros with tools.
Wow, only 10%? That's rough. So emotional stuff and no research are the main traps.
Spot on, and panic selling ties it all together. Markets go up and down, like waves at the beach. If you buy on a high wave without checking the tide and sell when it pulls back, you're out wet and empty-handed. The key is patience and knowledge. Treat it like learning a sport. You practice basics before the big game. New investors who skip that, they burn out fast, watching savings vanish.
Yeah, I don't want that. It makes me think twice about jumping on every trend I see.
Smart move. But trends are everywhere, right? Like those hot tips from social media or friends promising easy money. How exactly do chasing those lead to total ruin?
Yeah, like my buddy at school was telling me about this crypto coin that's supposed to explode any day now. He said it's a sure thing because some influencer swore by it. But how does just following that kind of stuff wreck your savings?
Your buddy's excitement is totally normal. Tips from friends or online feel like insider secrets, right? Like getting a cheat code for a video game. But chasing trends like that often ruins savings because the hype builds fast, but it doesn't last. Picture this. You're at a party where everyone's dancing to one song, so you drop everything to join in. The music's pumping, lights flashing, but then the track ends abruptly and the floor clears out. That's trends in investing. People pile in on the buzz, driving prices up way beyond what the thing's really worth.
So the price goes crazy high just because everyone's talking about it?
Exactly. Take NFTs a couple years back. Everyone from TikTok to your cousin was saying, buy this digital art, it's the next big thing. Folks threw thousands at them, thinking they'd flip for millions. But once the excitement cooled, and it always does because trends fade like summer fads, the values crashed hard. Many lost 90% or more. Why? No real backing, just hype. You buy at the peak thinking it's climbing forever, but timing fails every time for chasers. Markets aren't parties. They correct when reality hits.
I almost clicked on one of those ads last week. Felt exciting, like I could be part of something huge. But if the hype dies, you're left holding junk?
Spot on. And friends' tips sound reliable because you trust them, but they're often just repeating what they heard, not what they studied. My sister did this with a hot stock tip from her feed, some app promising 10x returns in weeks. She put in $500 from her babysitting gigs. The trend was all over Reddit, so prices soared for a bit. But then the company reported weak sales, and poof, down 70% in days. She sold to cut losses, but that $500 became $150. Ruined her savings plan for a new phone. Chasing means you're late to the party, buying high and first out when it sours.
Ouch, that's her actual money, gone. So, is it always the timing that's the killer, or something else?
Timing's huge, but it's tied to the hype cycle. Trends start with a spark, maybe a tweet or news blip, drawing crowds. Prices balloon on emotion, not earnings or growth. When the crowd leaves, values plummet because there's no foundation. Stats back it. Studies from places like Vanguard show that following momentum stocks, the hot trends, underperforms the market by about 5% a year on average for regular folks. You're not investing, you're speculating, like betting on a horse because it's got a shiny saddle. And if that horse stumbles, your savings take the fall.
Makes sense. I guess those influencers don't care if we lose, huh? They're just hyping for clicks.
Yeah, many are in it for the promo fees or views, not your wallet. Remember the GameStop frenzy again? Tips flew around like confetti. Buy now, moonshot incoming. Thousands jumped in. Some made quick bucks, but most who chased late watched it crash from $483 to under $50 in months. Savings ruined, regrets piled up. The ruin comes slow at first. You hold, hoping it'll rebound. But fees tick away, stress builds, and suddenly you're out big. It's not just the loss, it's the opportunity cost. What that money could have done elsewhere, like in a steady savings account growing quietly.
Steady sounds boring after all that excitement, but yeah, I see how chasing could leave you broke and kicking yourself. So, avoiding trends means what? Just ignoring all the noise?
Not ignoring, but filtering. Ask, is this based on real value like solid sales or innovation, or just buzz? Do your homework. Read company reports, not just memes. Trends ruin because they trick you into FOMO, fear of missing out, leading to rushed buys. My old roommate fell for a green energy trend, poured his emergency fund into one solar stock tip from a podcast. Hype peaked. Then regulations hit, stock tanked 80%. He had to borrow for rent. Lesson? Chasing savings ruin is like chasing fireflies at dusk. Pretty lights, but you end up empty-handed in the dark.
Fireflies. That's a good one. I don't want to be that guy borrowing for basics, but if trends are such a trap, maybe I should split my money up somehow to not lose it all at once?
That's a sharp thought. Spreading it out could soften the blow if one thing flops.
Yeah, like the saying about not putting all your eggs in one basket. I've heard that, but does it really work that way with money?
You've got it. That's exactly the idea. And it's a game changer for keeping your savings safe. Spreading your money around is called diversification. And the reason to avoid dumping it all in one spot is simple. If that one thing tanks, you could lose everything. No backup plan. Imagine you're at an arcade with $20 from chores. You could shove it all into one claw machine, hoping for that big stuffed bear. Feels thrilling if you snag it, but if the claw slips even once, poof, quarter after quarter gone, and you're out cold. That's what happens when new investors bet big on a single stock or crypto. One bad report, scandal, or market shift, and your whole pile vanishes.
Oof, arcade money's hard to earn. So like, if I put everything in one hot stock because it seems perfect, what could go wrong in real life?
Real life hits hard without a safety net. Take my buddy from college. He was all in on one electric car company stock at 20, thinking it'd skyrocket like the hype said. Used his entire summer job savings, about $1,000, because one winner makes you rich quick. Sounded good, right? But then supply chain issues hit, the stock dropped 60% in weeks. He didn't just lose most of it, he had nothing left for books or even gas money. No other investments to balance it out, so one failure wiped him clean. Diversification spreads the risk. Like buying tickets for a few games at the arcade instead of one. If one flops, others might pay off, keeping you in the game.
Gotcha. So it's not about getting rich super fast, but not going broke either. But what if that one stock does blow up? Wouldn't I miss out on being a millionaire overnight?
That's the objection everyone has at first. One hot pick could make you loaded, sure, but the odds are like winning the lottery while blindfolded. Stats from places like the SEC show that single stock bets fail way more often than they succeed for beginners. About 80% of individual stocks underperform the overall market over time. You're betting on perfection in a world of surprises. Competitors pop up, economies shift, or the company just messes up. Remember Blockbuster? Folks who went all in on video rental stocks back in the day thought it was unbeatable. Then Netflix streamed in and poof, bankrupt. Those investors, total wipeout, no cushion. Spreading means you might not hit the jackpot as huge, but you avoid the total crash. It's like packing a backpack for a hike. One trail might flood, but if you've got side paths, you still reach the view.
Backpack hike. Yeah, I like that. Makes it feel less scary. So how do you even spread it without it being complicated?
Not as tough as it sounds, especially starting small. Think index funds or ETFs. They're like baskets holding a mix of hundreds of stocks, from tech to stores, all in one easy buy. For your part-time job cash, say $500, you could put some in a broad market fund that tracks the whole economy. If one sector dips, like tech during a slowdown, others like healthcare might hold steady. My niece started at 16 with $200 in a simple S&P 500 fund. It's just 500 big U.S. companies bundled up. No single failure guts it all. Over years it grew without her babysitting every headline. The key fact? Diversified portfolios lose less in bad times. Studies show they cut risk by up to 30% compared to going solo on one thing.
S&P what? Oh, like a safe bundle. Cool, so even if I'm not an expert, that could work for me?
Totally. It's beginner proof. Avoid the trap of thinking one shiny stock will save you. That's the quick rich dream that burns most. Without spreading, a single flop, no safety net, turns savings into stress. Like if your phone dies and you've got no backup plan, you're stuck calling for a ride. Investors who ignore this, they learn when bills pile up and regrets hit. But you, asking this early, you're building that net now. Start small, mix it up, and watch how it steadies the ride.
All right, I'm sold on not going all in on one thing. Feel smarter already. But hey, even with spreading, aren't there these little fees that just nibble away like no big deal?
Oh, those little fees? They might seem like no big deal at first, like a couple bucks for a soda. But ignore them and they can quietly chew through your gains over time, turning what could have been solid growth into a disappointing trickle. And risks? Adults aren't overhyped. Skipping them means you're blind to sudden drops that hit out of nowhere. Let's break it down so you see why paying attention here is key, even with your money spread out.
Yeah, I mean, apps charge like 1% or something, right? That's tiny on $100.
Tiny now, but watch it compound. That's when small fees snowball into big bites. Say you invest $500 from your job, and it grows 7% a year, which is average for a diversified fund. Without fees, after 10 years, you'd have about $1,000. But slap on a 1% annual fee, it drops to around $850. That's $150 gone just for the service of holding your money. Hidden charges pile up too. Trading costs if you buy and sell often, or account maintenance fees that sneak in. My friend started trading stocks at 18, thinking low fees meant free reign. He didn't notice the $5 per trade adding up. After a year of tweaks, it had eaten 20% of his small pot. Ignored fees compound losses, like interest on a bad loan, but in reverse for your savings.
Compound like how savings grow, but backwards? So even if the investment's good, fees steal the extra?
Exactly. And it's sneaky because they don't hit all at once. You see the balance, think it's fine. But over months, those nibbles add up to a chunk. Now, risks, overlooking them is like hiking without checking the weather. You assume sunny skies because it's clear now, but ignore the forecast and a storm rolls in, soaking everything. Investments have market risks, where the whole economy dips, or specific ones like a company scandal. If you don't weigh them, unexpected drops catch you flat-footed. Remember 2022? Inflation spiked. Stocks fell 20% on average. Folks who ignored risk warnings panic sold at lows, locking in losses. But those who diversified and knew the risks, they held, and many recovered by now.
Stormy hike, got it. So my part-time cash in a fund, could it just drop like that without warning?
It can fluctuate, yeah. But ignoring risks means no plan for the dips. Key fact, every investment has volatility, ups and downs like a roller coaster. Bonds might be steadier but pay less. Stocks swing more for higher potential. If you skip reading the fine print on risks, like how a fund's past drops or economic ties, you're gambling blind. Take my aunt. She put savings into a safe real estate fund at 22, ignoring the risk of housing bubbles. Fees were low, but when prices crashed in 2008 echoes, her share lost 40%. Hidden charges from early withdrawal to cut losses made it worse. She wished she'd asked, what's the worst that could happen? And plan for it, like an emergency buffer.
Buffer, like extra cash aside? Makes sense, but adults always say risks are everywhere. How do I know what's overhyped?
Good catch. Not all warnings are equal, but basics like market crashes or company fails are real, backed by history. The S&P 500 has dropped 10% or more about once a year on average since the 80s. Ignoring that means no mental prep. Fees tie in too. High-risk trades often come with higher charges, compounding the hurt. Studies from Morningstar show that even 0.5% extra fees can cut your long-term returns by 25%. It's not minor, it's math working against you. Start by picking low-fee options. Index funds often charge under 0.1%, way better than active ones at 1%. And for risks, use free tools like prospectuses that spell out this could lose value plainly.
Prospect what? Oh, like the info sheet. So low fees plus knowing risks keeps more money mine?
Spot on. Overlook them and compound losses from fees plus sudden drops turn a $1,000 start into far less, or nothing if you bail in fear. But grasp this and you're ahead. Treat fees like a leaky bucket. Plug them early. Risks like potential rain, pack accordingly. My nephew ignored both at 19. chasing a high-risk crypto with 2% fees. Market dipped 50%, fees doubled the pain, and he lost $800. Now he checks everything first. You avoiding that? Smart.
Leaky bucket. Yeah, I don't want my savings dripping away. So to not mess up on this, I got to read up on fees and what could go wrong, right?
Absolutely. And that's where learning the basics comes in. It's your foundation, like knowing traffic signs before driving. Start simple. Free sites like Khan Academy or Investopedia explain fees, management costs, and risks, chance of loss, in short videos. Apps like Vanguard have beginner guides, no jargon, just facts. Pick one low-fee, diversified fund. Read its risk summary. It's usually a page saying, past performance isn't future, markets vary. Practice with a fake account to see fees tick and prices wiggle without real stakes. My first time, I paper traded $1,000 virtually. Saw a 1% fee shave $10 off gains and a mock drop teach me to wait it out. Basics aren't boring. They're your shield.
Fake trading sounds fun, like a game. Okay, I think I get it now. Fees compound sneaky, risks drop surprise bombs, but checking them keeps me safe.
You've nailed it. Starting with that awareness means you're not the newbie who loses fast. You're the one building steady. Keep that curiosity, and your part-time savings could grow into something real without the regrets.
Thanks. Feels way less scary now. I think I'm ready to learn those basics and get going smart.